Hey traders, this is Blake Morrow with Trader Summit. Make sure you join the most highly anticipated online free trading event of the year, October 21st through 23rd at tradersummit.net. We're gonna have so many great speakers for you for those 3 days. We have speakers like Danielle DiMartino Booth, Brent Donnelly, Mark Minervini, Peter Schiff, Danny Blanchflower, Helene Meisler, and many, many more. So make sure you do register, it's free. Also, our sponsor 8cap will be giving away 2 iPhone 14s to 2 lucky winners just for registering. So what are you waiting for? I'll see you there. Hey traders, this is Blake Morrow with Trader Summit, and I have with me for the first time in a very long time, Mr. Mark Dow. He's author of Behavioral Macro. Good to see you, Mark.
Good to see you, Blake.
Well, it's actually great to have you here. I wish we'd see you, but we're not going to be using our camera today, which is fine. But it's been years since you and I spoke. I think
it has. It's been a while.
It has been a while. Well, I know a lot has changed since you and I has met last, and you know, the dynamics of the market has shifted quite a bit. And so, really, I wanted to sit down with you because, well, first of all, the reason for this is we have our Trader Summit event that's coming up in a couple of weeks. You had been at our Trader Summit event on a panel in the past. You couldn't do it this time, so this was my second choice. So I'm so glad that I get to pin you down for a little bit and ask you some questions.
I'm glad you did, Blake.
Well, let's talk a little bit about the markets and focus about you know, on the stock market, where we're at. We've seen, obviously, you know, the market took a turn for the worse at the beginning of the year. We're down trading near our lows ahead of some key inflation data coming out tomorrow. How do you feel about the markets and where they're at currently? Do you feel that there's some more downside? Do you think that you know, you might be shopping for some equities moving forward?
Yeah, so it really comes down to it's kind of binary right now. It really comes down to what inflation does. I mean, my breakdown of what happened, you know, what happened with this inflation, is as follows, and I'll explain why it matters. You know, we had a shock to the system that was COVID, and then, you know, at first we didn't know if that shock was going to be deflationary or inflationary, because we weren't sure what, you know, how the supply and demand were going to react. But but the general rule with a shock is the longer the shock persists, the greater the odds, the probability that it bleeds into other categories not directly affected by the shock.
Yeah.
So we had an initial shock, and then we ended up having 4 waves of COVID that had a cumulative effect on the supply side. And through its persistence, and then of course it was culminated, the supply shocks were culminated in a war that hit energy prices in particular, just as we were making a little bit of progress on certain fronts. At least the goods market, we got hit by the invasion of the Russian invasion of Ukraine. So, but by then, inflation was already starting to bleed into these other categories, right? And that's a slower process, and it's a stickier process. So we got hit with the supply shocks. Income was supported with strong fiscal policy, and that allowed people to shift their consumption onto goods. As we know, we remember off the port of Los Angeles and Long Beach, we saw all those cargo ships for a long time, right?
Yeah.
So all this energy went into goods, and goods prices spiked. And then over time, it started bleeding into services and and wages and other things. Now, goods prices and transport prices have been coming down, and commodity prices to a significant degree have been coming down sharply. But a lot of our consumption has shifted onto services, and that's the sticky part now. So the question is, as the goods prices and the commodity prices and the transport prices come down, how fast will that bleed over into these service prices? Right? And to accelerate that process, the Fed is hiking, right? They want to make sure that that process gets going. Now,
Right.
when everyone said, and lately people have been saying, well, you know, we see that prices are falling in goods and commodities and transports. Services are going to come. The Fed is going too fast. Let's ease up now. And the Fed is saying, listen, Our forecast didn't work out very well last time. Why should we rely on them now? We need to see greater signs that the sticky elements that finally got the Fed off the sideline, because the Fed was sitting there praying that inflation was going to go away, right? That it wasn't going to bleed into the sticky elements. But shock after shock after shock, it finally did. And at the last minute, then they said, okay, we're going in great guns. And that's where they are now. But they don't want to trust their own forecast because they know they could be wrong. And the worst possible thing, the 70s scenario, is where inflation calms down just a little bit and then comes roaring back because you didn't kill it when you had the chance. So they need to see a little bit more. So to get back to your original question, are we going to see elements of that, right? Are we going to see elements of that so that the people can say, okay, now the Fed will feel comfortable taking its foot off the brake, maybe not putting its foot on the accelerator again, but at least taking its foot a little bit off the brake, or not pushing as hard on the brake as they are right now. And tomorrow will give us some sense for that. The other thing is what we have underestimated the stickiness of inflation at every juncture over the past whatever months. We've also overestimated the extent to which earnings would be cut back, reduced, shrink. So we also have earnings that start to kick in this week. It'll be interesting to see if these patterns continue, underestimating inflation, underestimating earnings.
So do you think
those are the near-term drivers? If we get a resolution to that, I feel pretty good. Are equities cheap? Are the equities expensive? It doesn't really matter. We live in a multiple equilibrium world. Every single cycle tops at a different level, right? At a different multiple. So there's no one answer. This is cheap. This is expensive. What happens is there's a catalyst. The market is super underweight. People start buying. FOMO kicks in, and then we find out later whether or not the fundamentals follow it.
Yeah. Okay. That does make a lot of sense. And so, let me ask you about tomorrow, since we're gonna. I put a rush delivery on getting this through editing, because inflation, our CPI data is coming out tomorrow, and everybody's going to scrutinize it to the high heavens. But is tomorrow's inflation data going to really matter? Even if it comes in slightly below expectations, isn't the Fed going to want to see more, Mark?
It just depends on the breakdown. So like what we saw today in PPI, and I know PPI doesn't matter as much, but we saw that the services were showing to be a little sticky. And again, that's the part that the goods inflation, the initial shock bled into services, and now we need to see it bleed back out, right? If people are still booking holidays, right, and cramming on flights, it's going to be, and going to restaurants, it's going to be, that repressed service demand. It's going to be hard to come back down. And I think, in retrospect, we had all these shocks, right? And we did, and we also had a fiscal response that was stronger than it needed to be. We know that now, right? Yeah. Ex ante, I probably should have done the calculation that Olivier Blanchard did, the IMF, old IMF economist and MIT economist, where he just kind of added it up and said, well, the output gap is approximately X, and the fiscal packages that they're putting forward are approximately 1 3/4 times X, so it's going to be too much. That was the right approach. So we did a little bit too much. The good news is we're looking better than anybody else. I mean, we're not by far not the only economy with an inflation problem. In fact, this is why I think it's misguided to think this is a monetary problem, right? Because we had big monetary stimulus before it never gave us any hint of inflation, whereas we saw fiscal and supply shocks, and that's what got us the inflation. If it were just about the Fed, these other countries wouldn't be having the same degree of inflation problems that they're having now.
Would you attribute some of that to the strength of the dollar that we've seen as of late? I could say more than late.
It's been a while. No, I don't think so. I mean, to me, the dollar is a very simple story. I've been in markets for a long time, and every time, towards the end of a cycle, what happens? The Fed usually raises rates, and and that's good for the dollar. But more importantly, we see risk off. And think about it. If you go to, Singapore Investment Fund is dollar denominated. Funds across the world are primarily dollar denominated. Yeah, they're local denominated funds too, but you're not going to find Brazilian real denominated funds in the US or Europe, but you're going to find a lot of dollar denominated funds in Brazil, right? Yeah. So, if the denomination, the currency in which your fund is denominated, or your investments are denominated, matter a lot, because when you de-risk, you go back to that currency. right? You go back to that home currency. So typically in a risk cycle, like what you see is at the beginning, people start tiptoeing out the risk curve. They go, oh, people are making a little bit of money. Maybe I should get out of treasury bonds and buy some high yield. Or maybe I should buy some chicken equity, right? The safe equity names. And then pretty soon, a few years go and you see a lot of other people making money, and pretty soon you're levered up buying NFTs and coins, right? And then the whole thing ends. Well, emerging markets or foreign currencies taking currency basis risk is further out the risk spectrum, right? So when you have a de-risking process along the lines of what we've seen over the past 18 months, right? You'll see people selling their investments in foreign currencies and going back to the home currency, which is primarily dollars. That's all it is.
Oh, that makes a lot of sense. A lot of people call the dollar, the wrecking ball, the juggernaut, and it's wreaking havoc across the globe. But it's to you, do you think that the dollar can continue to rally from here?
I think when equity stops selling off, the dollar stops rallying.
Okay, well that's fair enough.
Más o menos, más o menos. I think that's where we're at, particularly in the short term, given the positioning, right? Yeah. Because they're correlated. But that's really what this is about. If it were about some story where people borrowed in dollars all over the world and they're getting crushed and it's going to implode and depression, all the stories that you hear, we would see different behavior in credit spreads, right? We talked a little bit about this earlier, that private sector balance sheets are in really good shape, which is unusual for this point in an economic cycle. And a lot of that has to do with, one, having rates low for so long. Everybody had a chance to term out their funding, right? You were an idiot over the past few years if you didn't refund at longer term low rates. Right. Everybody did, not just their houses, but businesses did this. Business did this too. And we have to be mindful that a lot of companies after the GFC had PTSD, right? I mean, the home builders were underbuilding until the COVID shock. And then after the COVID shock, their reaction was to build even less until they saw how strong demand was, right? The first oil companies, right? They had a big bubble going into 2014 of just a frenzy of production, right? They were going crazy. We couldn't even spell, the ESG back then. I mean, it existed, but we didn't care. People were drilling and drilling and drilling, but they weren't making any money. And then when that bubble popped, they cut back for a long time, and we saw from 2014, 15 until after the crisis, they weren't investing. Their first response to the COVID crisis was to cut back dramatically as well, even further. So now, anyway, now that we're kind of coming out of this crisis, we're getting toward. I think we're late in the de-risking process. Once this whole thing ends, we're going to see the proper response, and people will sell dollars again and start taking risk incrementally.
Okay, and let's talk a little bit about bonds, because you were talking about yields, and I mean, here we are with the you see obviously home mortgage rates, but if you look at like the 30-year bond as we have on the screen here, I mean, yields are screaming higher, and we haven't seen that typical 60-40 portfolio do so well this last year. So what do you make of the bond market moving forward?
Well, I think it's actually a good thing, because now a lot of people are going to have alternatives to stocks, right? Right. So it's just a matter of when we get to that point where we know the Fed is seeing the effects on the sticky elements of inflation that we talked about. When they see what they want to see there, then I think we're going to be okay. It's not clear to me that the equilibrium yields have to be this high or have to be this low. A lot of people, I mean, for a long time, people tend to set their expectations about where yields should be or where Fed funds should be based on history, their life experience, right? But there's no rule that says it has to be at 2% or 5% or 1%. It does. So we shouldn't get hung up on it. A lot of people who've been angry at monetary policy are angry because in their head, free money is wrong and money has to be 5% or 4%. It just has to, for no rhyme or reason. But the thing I always say about money is, I always twist that old phrase that you can lead a banker to liquidity, but you can't make him lend, right? And this is the difference between monetary and fiscal. So the difference I have with a lot of people is I think fiscal is what drives things, not monetary. Monetary is way less powerful than everyone thinks it is. And you say, but look at this bubble we had, and we had free money for all this time. And as I've said on many occasions, we had a bigger bubble in 2000 in 2000, in a stock market bubble. Valuations were higher then, and Fed funds was at 5%. The nastiest lending from 2005 until 2007, in the housing bubble, happened with Fed funds at 5%. If you think you're going to make 200%, like you think you're going to make in NFTs or coins or whatever, if you think you're going to make 200% over the next couple of years, you don't care if the funding rate is 3% or 5% or 1%. It's the same number to you, right? It's about greed. And I've used so many times that JP Morgan quote, the one where he says, "Nothing so undermines a man's financial judgment as seeing a neighbor get rich." So the behavioral way I look at it, people take risk when they think their job and their income is fairly secure, their balance sheet is in reasonably good shape, and they see other people around them making money. That is way more important than the Fed funds rate at 4% or 2% in my estimation. So I think, everyone always says, well, yeah, but when rates are low, everybody borrows. Well, who's lending? I understand why people want to borrow more when rates are low, but who wants to lend more when spreads are compressing? And at the end of every risk cycle, Blake, we know what happens. People are lending at ridiculously tight spreads every single time, right? And credit standards are dropped to one degree or another. It hasn't happened much this time, but in previous cycles, it has. So the only reason they take more risk at tighter spreads, it's an increase in risk appetite. And it would have happened at 3% or 5%, maybe a little bit less. It happens at higher rates. But if you're below 5, you're going to get a bubble. You're just going to end up in people taking too much risk because it's human nature, right? We've seen it too many times. So when people say, well, listen, we know this was a big monetary accident. This whole bubble was blown by the Fed. And I go, well, how do you know that? What's your evidence? And they go, well, we just know. It's common sense. It's obvious. And like I said, if we weren't able to point to other bubbles with a 5% Fed funds rate, then their case might be more compelling. If you were able to explain why people want to lend more at tighter spreads over the course of a cycle, then the case would be more compelling, right?
Yeah.
But basically, I just think people have the wrong economic model in their head. They still think there's a loanable funds model where the Fed creates the base money and gives it to banks somehow, and then the banks can lend it out, and the banks can lend out a multiple of it because of fractional reserves. That's how people think, but that's not how it works, right? The banks aren't constrained they're constrained by liquidity ratios and by capital and their capitalization, which, if you hold treasuries or you hold a Fed funds deposit, those are both high quality liquid assets, right? The low rates is not the common denominator of every bubble. The common denominator of every bubble is people getting greedy and dropping credit standards.
Hence behavioral, right?
Absolutely.
So.
Now, again, at 7% or 10%, it's probably not going to happen. But at 5% or 3%, doesn't matter much, or 2%. Yeah. Eventually, people are going to be taking too much risk in buying stupid coins.
That's true. The Fed, as people talk about, they're engineering tighter financial conditions, but you have some comments about QT, right?
Yeah.
So how do you feel about the world's view of quantitative tightening right now?
Well, I just don't think they understand how the mechanism works. Think about it. If the Fed does QT, Blake, how's that going to change your portfolio? What funding is that going to pull? What's the mechanism through which that pulls your funding?
Right. Yeah.
It doesn't. It doesn't. Now, so it's an asset swap. Most people, let's just look at the average portfolio. We're talking about the 60-40 portfolio, right? Yeah. Let's say in the 60-40 portfolio, 20% of half of the 40, so 20% is in T-bills, 1-year T-bills, right? If the Fed buys those and gives you a cash deposit at the Fed, I mean, you can't have one, but it can do it for a bank, right?
Right.
Are you going to turn around and you're going to buy coins with that? Are you going to buy Tesla? Are you going to buy Apple? Or are you going to buy? No, that would change your 60-40 allocation,
Correct.
or your 60-20-20 allocation. You're not going to do that. Now, you may want to do that later because your risk appetite has changed for some other reason. But initially, if someone takes half of your bond portfolio and gives you a deposit, your risk profile hasn't really changed much. And that's what QT does, right? And it takes it back. And banks don't need this money to lend out. There are reserves. In fact, we've got $2 trillion sitting in the reverse repo facility, right? That can just come right out. Now, it used to be until 2008 that the amount of reserves in the system was like 20 billion with a B, not trillion, billion with a B. And that was it. And the Fed had a thing called a daylight overdraft facility. So intraday, if a bank needed reserves to settle something, because the difference between bank reserves and treasuries, they both count as high quality liquid assets for regulatory purposes, which is important, but they're slightly different. And they're different in this one respect. Treasuries, ironically, are more liquid in that you and I can own treasuries. We can't own Fed fund deposits. Only banks can.
Yeah.
And when if we do a treasury transaction, it settles T+1. Whereas if you move Fed fund deposits, if you use Fed funds to pay another bank to settle something, it settles T+0, right? So these are basically the distinctions. So they had this daylight overdraft facility, allowing banks to be able to settle intraday, and banks could relax about having enough reserves. And the system went on having $15 to $20 billion in Fed funds for like 20 years. And what happened over those 20 years? Credit increased by 500%.
Wow.
That couldn't happen. I can give you. I wrote it up in a blog post a while ago. I can give you the exact numbers and the exact dates, and you can check them, right? But there was a long period in which reserves stayed flat and credit exploded. If you believe in the loanable funds model, the fractional reserve model of banking, that couldn't happen. The banks wouldn't have had the fuel to continue their credit expansion. But it means it doesn't work that way. Right? It works endogenous. If you want to look it up, for people who want to look it up on Wikipedia or whatever, endogenous money is how it works. And our system is much more collateral based now. And it doesn't. So people, but unfortunately, loanable funds is the model that we learned in economics when we were in school, in the economics textbook. That's what we learned, and even in graduate school. And it's wrong, right? There was a point at which in time when it was kind of right. But now for sure it's wrong, but people still think that way. And this is what scares them about QT. Now, QT and QE do have, I call it a placebo and a reverse placebo effect. So many people have the wrong conception of how it works, is that they think it's going to help. And so they get more positive and they take more risk. But it doesn't really matter much. It matters for settlement. So under stress, the banks need more liquidity for settlement purposes across banks because people are transacting more rapidly, and they might have a demand for cash, or back in the GFC, people were lined up in front of ATMs hoping there was still money in there. That kind of there still can be a demand for that stuff. But basically, settlement liquidity gets conflated with market making liquidity, which is totally different. Market making liquidity is that people making markets how they feel like risk wise. And when volatility shoots up, what happens? The bid and the ask widen out, and they get shallower. They're not as deep on either side, and that has nothing to do with the size of the Fed balance sheet. It's purely risk appetite, and maybe regulatory considerations for some of the banks who might be making markets, right? But that's what it is. And then the other kind of liquidity, the third kind, because there are three basic kinds. There's the settlement liquidity, which the Fed does the Fed does control. There's this market making liquidity, which the Fed only very indirectly can have an influence on, but it's mostly about market makers' risk appetite. And the third is what I call rollover liquidity, right? Will you extend credit to a company that needs to roll over its debt?
Yeah.
Or someone who wants to fund a business or new debt, right? And that's also a function of risk appetite. It doesn't really matter what the Fed balance sheet size is for that, as I was saying by my example of having had 15 to 20 billion in reserves for like 20 years. I think the period was like 1983 until 2006 or something like that. It's a ridiculously long period of time. So people kind of just say liquidity in this generic sense, and that makes them think that that QT is going to matter for these other types of liquidity, and it really doesn't. So what I'm trying to say is people will react to it, and it can become the story. In 2018, it became the story because the market was already going down, the economy was slowing, because fiscal stimulus that Trump had pumped up was rolling off, and the tariffs were starting to have an effect. You can see this starting around June of that year, that a lot of the indicators were showing economic slowing, and the Fed was trying to normalize rates and reduce the balance sheet. They asked Powell if he was going to stay on course, and he said it's going to be with QT, and he goes, it's going to be like clockwork, like paint drying, because they kind of realized, I think the Fed learned in all this QT process that it's not as powerful as they thought it might be, and even Bernanke has said as much, since leaving. So they were kind of thinking it's not a big deal if we wind it down. Let's just put it on autopilot, so it's not a problem. But because the market believes it's a bigger deal than it is, the market freaked out. And even though the market was already down a fair amount, we went down like another 8% in 2 days in the S&P. And then finally, to short circuit the panic, Powell came out and goes, okay, we're not gonna, we're gonna stop. We're gonna take our foot off the brake, right? And of course, from that point until July, when they actually did increase quantitative easing, or when they did cut rates again, because they didn't do anything from that December until July, this S&P went up 50%. So they weren't adding liquidity to the system at all, and the S&P went up 50%. So what I'm trying to say is the mechanistic effects. There aren't any mechanistic effects on the stock market from QT or QE. They're psychological ones. It's really there to, they thought that maybe it suppresses yields at the long end, and that might facilitate capital formation. But even that is really uncertain, because as you've seen, you remember over the period of 2011 until 2000, and I forgot what it was, the first 3 QEs, every time the Fed announced QE and started QE, what happened? Yields went up. Why did that happen? Because people's economic expectations were more important than the supply and demand dynamics, whether more important than whether the Fed was buying or not. And then typically what happens is, okay, we feel better, everyone feels better, the markets rally, we go, okay, we start feeling more optimistic, and then the economy disappoints those expectations, right? And then the Fed ends its Q, and then yields start coming down again. So there was a negative impact. The sign with which Treasury yields were impacted by QE was the opposite of what people posited ex ante, right? And we saw this time and time again. So it's not even clear how much it really affects bond yields, because if it's being done in a way that alters economic expectations, or it coincides with economic expectations changing, that's more powerful than whether or not the Fed is buying
the actual action of it. So that brings me to another point that you really, it seems to me, and it really kind of reaffirms some of my ideas, that the Fed and other central bankers, what they say and how they alter expectations is probably the most important lever that they have to pull. Is that correct?
Yes.
And then how do you feel about this is recent, how do you feel about Andrew Bailey's behavior over the last 24 hours and his announcement of ending gilt buying here in the next few days?
So my read of this, Blake, is a little bit different from others. I think at first they said, okay, something's broken in the market. I mean, the UK has a couple of problems. It used to be a huge power. It used to be the financial center of the world, and it's been shrinking, right?
Sure.
And the shrinking of the UK or London as a financial center was kind of postponed by just financialization and globalization, right? It was a natural hub for people. And then after the GFC, and then after Brexit, After the GFC, there was a general impulse towards, okay, we have too much finance. It was 33% of the UK economy. That was clearly too much and made them too vulnerable, and things had gone a little too far. So they started paring back. And then after Brexit, people said, do we even want to be here? I'm not sure I trust this economic management. We're less linked up to Europe. Maybe we should move on to the continent. So these things started to whittle away at that. No one has to buy gilts the way they have to buy treasuries. The Singapore Investment Fund isn't denominated in pounds, right?
Yeah, that's a good point. Yeah.
Right.
Yeah,
so it's not needed. So it's easy to get, but they have a large pension industry, and they were using leverage to meet their targets, and it almost always comes back to leverage. So it's easy to get a mismatch in the gilts that are being issued and the gilts that are being demanded, right? But so basically they had a levered up market that got caught off sides, and then reaction triggers reaction, stop triggers stop, and then people say, oh, like I was saying earlier about balance sheets, if you're comfortable with your balance sheet, you're not panicking when you see some kind of external shock to square up positions or do anything. You'll say, okay, what do I need to do? Maybe I'll trim this, I'll do that. But if you're way out over your skis, the way some of these pension funds were trying to hit their bogeys, they basically, it looks like to me they had a version of the risk parity trade, where you buy equities and then you buy a leveraged amount of bonds as a hedge, because typically they have a negative correlation. It's a little bit like that, but they were doing it to try and hit their
targets,
insurance bogeys. Now, once they saw this reaction, the markets were in a rough spot already when that budget was announced. So I don't think it's as much about the budget per se that was announced as it was just the chain reaction that it triggered. When you're vulnerable like that, anything can be a trigger. Anything can be that straw that breaks the camel's back. So that once that started, fine, and the Bank of England stepped in and said, okay, we're going to make sure that this is orderly, and then they did.
Are you a sterling buyer down here?
I would have no. I did that morning of the panic. I did buy some, because at some point it
at the 105 level, you're like, oh yeah.
Yeah, I mean, it was like 104 or some ridiculous amount or something. I mean, it was really, and then it went to 108 and I got out, just got out. One of those, it was just a flip. It wasn't a view. Looking at the chart, I think it's going to go back now to the overall dollar view. It's going to be progressively less idiosyncratic as they handle this, as this problem kind of fades. But this latest move, what he said about ending, we're going to intervene, but we're going to end it by Friday. I think there were a lot of guys who said, I don't like the prices I'm getting right now. I know they're not going to let the system crash. I'm going to wait and moral hazard a few basis points out of this thing, right? So I think a lot of the pension funds who should have been squaring up their positions and taking their lumps were waiting. They said, I've got a free option on some kind of rebound. I'm going to wait. So he said, screw it. This thing is going to end on Friday. So square up your book now. So I think he looked at the situation and said, okay, we can handle this. We can make sure that it's orderly. We understand the size, the dimensions of the problem, and it's manageable. But these guys need to get they need to start acting, and they can't hide behind, take this free option. So I think the announcement that they're going to end it on Friday, which usually I'm against central banks putting out a target for people to shoot at, because that's what we do when we see a target or a date. We like to shoot at them.
Right.
And right. I mean,
totally.
you've been Forex markets for a long time. So I'm against that. But in this particular case, I think this was a message to the pension funds in the UK saying, guys, stop hiding behind my skirts, square your positions by Friday. Okay. That's my interpretation.
Wouldn't it be nice if all central bankers acted that way?
Well, yeah, but yes and no. I mean, you've got to make sure that there are orderly transitions, right?
Yeah.
But in some cases they did. If you remember, Bernanke, Paulson, and Geithner, when Geithner was still at the New York Fed, they all got together and sat those banks at a table and forced equity down their throats, and they didn't want it, right? And that's what made the difference between the still ailing European banking system and ours. The European banking system, they all hid behind their national regulators and kind of misrepresented the severity of their situations to the EU, because the French didn't want the French banks taking a hit, and the Italians didn't want the Italian banks taking a hit, and the Germans didn't want the German banks taking a hit. So no one ended up recapitalizing. And that action by Bernanke, Paulson, and Geithner doing stress tests and forcing them to take capital ultimately gave the system confidence for the banks to go out and issue a ton of equity on their own to the market, right? So there are times when they do these things, when they do force, but I think, and this has been a really good lesson of this recent period. Everyone said, "Oh, there's an S&P put, the Fed put in the S&P, the Fed put in the S&P," and I always said, "There's not a." I always resisted that notion strongly. One, because it implies there's a level at which they say uncle, and it's not that. They don't really care about stocks. They think directly, right? If they think the stocks are saying something about the broader economy, it concerns them a little bit. And if stocks aren't trading in an orderly fashion, if the markets are breaking, obviously that matters to them too. But what mostly matters is the credit market and the treasury market, that they function in order and in orderly fashion. So the Fed tends to think stocks will take care of themselves as long as we get the economy on the right track. We've seen that there's been a tension between, a lot of people say, "Oh, they'll never let the stock market fall 20%. Well, look, they have. Why? Because inflation is an issue. So there's an economy put. The Fed's got not a stock market put. What they care about, they know that stocks will take care of themselves as long as the markets are orderly and pricing is continuous, not discontinuous. So I think it's been a good lesson for people to disabuse themselves of this notion that the Fed, there's some kind of put, because the way it used to work, Blake, was there would be economic pressure because of some shock. Greece would be about to blow up and stocks would go down and people would panic. And they would, and the Fed wasn't, the Fed was on hold, right? They weren't doing anything. And they said, "Would you cut rates if, things are getting really bad? Would you cut rates if things are getting worse?" And then the Fed, the Fed head of the day getting interviewed would say, "Well, that's not in our forecast, but if that were to happen within our context of our forecast, then we probably would consider easing financial conditions." And then the headline comes across, "Fed says it will ease financial conditions." Right? And then they go, "You see, it's a Fed put. They came out to bail out the market." But that really wasn't. And that's
a great point. It's a headline I'm going to use, Mark. We don't have a Fed put. There's an economy put, and I think that's very well said.
The Fed doesn't have a stock market put. It has an economy put.
Yeah. There you go. Hey, I want to ask you before I had one last question I want to ask you about, kind of like what keeps you up at night. But I do have another FX question, because I know something that's very close to you. You and I like to focus on the peso, and we've seen this outperformance of the Mexican peso in this last year, and which I like. I'm kind of I'm a peso bull, if you will, at this point. But what are your thoughts about the dollar Mexican peso? Because it really has acted really well in light of this very, risk off, quote unquote, risk off type of environment we've seen recently. Do you have any opinions about the dollar Mex?
Yeah, it's been surprisingly stable.
Yeah.
And well behaved in a world where emerging markets haven't done great. I think a lot of it is they've been raising rates, right? I mean, they've got a 9% rate kind of thing, and people will take that. I really think it's that. Not much more to it.
Okay, well, that's fair enough. I look at it, and me, and I'm a lot like you. It's like, okay, we're seeing a lot of risk off in the markets. How is the peso not being sold? I'm glad about it, but kind of wondering, is there anything more to it that you may be thinking of?
Yeah, no, and I don't have a position in it right now, in part because I'm afraid that there might be if dollar Mex were to spike up, I would want to sell it. But here, you're afraid of it getting contaminated by risk off elsewhere. Up to now, it's held up remarkably well. It's had a few kind of short-term spikes, right?
Yeah.
Which would be painful if you were short dollar Mex. But by and large, it's been really, really, really well behaved. So maybe if we get another one of the spikes, I would consider it.
You would sell into it. Okay. Well, that brings me to the question I really wanted to ask you is what keeps Mark Dow up at night? I mean, there's so many risks, obviously, in the markets at current levels, or is there? But there's got to be something that keeps you up at night and keeps you, glued to your screens.
So I think we're going to be okay through all of this. We're going to have to slog through a little bit until we get those sticky elements of inflation, the more service-oriented components to start coming down. And I don't think we're going to get a meaningful recession because the balance sheets in the private sector are so good. People aren't going to have to refinance for quite some time. And like I said, if you're hanging like in 2008 when everybody had a bunch of housing, they owned a bunch of houses and they were over levered, things start to move and you go, oh Jesus, I better square up, I'm really vulnerable here because I'm over levered. That's not going to happen now. So the reaction, the knock-on effects, right, of us slowing down aren't going to be as great, right? So I don't worry about a recession so much. And apart from the geopolitical lightning bolts, one thing that does worry me is market making accidents, like flash crashes and things like that. I don't think they would undermine the economy, and the Fed is on the lookout for them. I think they would be fixed fairly quickly. But if you get a flash crash and you're, taking a fair amount of risk, 20% down is not a good feeling, right?
Yeah.
So as a trader and as an investor, I worry about that. I think what happened after the GFC is people misdiagnosed a lot of the problem. They blamed hedge funds and in essence, market makers, and the Volcker rules were, and some of the other regulations they put in place were kind of limiting on. It was more taxing to make markets. So financial markets were already quite large at the point of the GFC, and they've only grown since then. There are more assets under management, right? And the market making windows through which they must pass are a lot more narrow. So I get worried about things like we saw with in the UK. There's more scope for these kinds of accidents. As I say, I think people were looking for them and they would get on them quite quickly. But that doesn't mean, as a trader or investor, it would feel good if you got caught on the wrong side of one of those things, right? So
Yeah,
that's kind of what we see: less liquidity in treasuries, less liquidity in mortgages, and it's just people. We see volatility and we become more risk averse.
So it go back to that old fire in a theater, yelling fire and having just one exit and being more of a panic type of situation.
Yeah, I mean, it used to be that there were 50 people in the movie theater and 3 exits, and now we're down to 2 exits and there are 150 people in the theater. Right. That's kind of how I look at it. Market making hasn't kept up with the growth in financial markets.
Yeah, that makes a ton of sense. Well, Mark, I'll tell you, I am really bummed out for this the Trader Summit event, October 21st through 23rd. That you're not going to be there. But if you guys are listening to this, make sure you register. It's free to register. We're going to have a lot of great speakers, but we're not going to have you. But this is the second best that I could do, and I'm so glad to have had the opportunity to speak with you today. And thank you so much for taking the time for our Trader Summit community. I do appreciate it, and I know everybody else does. So make sure you all give Mark a thumbs up and subscribe down at the channel below so you don't miss any of this exclusive content. But Mark, what's the best way for me as a trader or anybody as a trader to follow your work?
Well, Behavioral Macro is the best way, but if you don't want to sign up for that, just follow my Twitter feed, and then you can also look at my blog. I've got a lot of older pieces in there that talk about monetary plumbing and how to think about risk taking and things like that kind of hopefully hold up over time. They're not time sensitive pieces, so you can go to the Behavioral Macro blog as well and read stuff there. So that's the best way. And I'm sorry I'm going to be missing your Trader Summit. It looks like a great event. You got a wonderful lineup. Maybe next year we'll pull it off.
Yeah, well, I hope so, Mark. I want to say thanks again, and thanks for spending your time with us. And we'll catch you in the next one.
I appreciate it, Blake. Thank you.
All right, bye-bye.
All right, bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.